Now currently what we have is a massive inflation of currencies, not only in the US but also around the world, and we've seen it happen over and over again. In my latest book, The End of Money and the Future of Civilization, I use the example of the Weimar Republic when they issued currency between 1921 and 1923. They were inflating the currency to such huge extent that people were taking the bills to the shops and wheelbarrows to get a loaf of bread. I think before the inflation began in 1921, the exchange rate between the mark and the dollar, I forget what it was, but say it was 500 to 1. And by the time the inflation ended, it was billions of marks to 1. And I have a picture of a 500 million mark note in my book, and I think in my collection I have a billion mark note. But typically this happens because you have this collusive arrangement between banks and governments. And this goes back to 1694, actually before that. But with the founding of the Bank of England in 1694, this sort of set the pattern for central banks to emerge in countries all around the world. And the basic agreement that was made between the financiers, William Patterson and his cohorts, and King William III, was that King William III would be given all the money he needed to fight his war against France without having to raise taxes on his subjects. And the Bank of England would provide that money based on government promises or government bonds, which put no value into the economy. On the bank's side, what they got was the privilege of lending banknotes into circulation at interest, and eventually they had a monopoly on the banknote issuance. Lending money into circulation, what it means is that a bank can create money. Now this is hard for people to believe, but that's the way it is. John Kenneth Galbraith, in his book Money, Whence It Came, Where It Went, I have a quote from him in my book. He said, "The way in which money is created by banks is so simple that the mind is repelled." And I've seen that in my own experience when I try to explain this to people. They really just can't believe it. But it amounts to this. You go to the bank and you ask for a loan. And the bank says, okay, well, what collateral do you have? You say, well, I own a farm. They say, okay, we'll give you a loan. We'll assess the value of your farm, and we'll give you a loan for half that amount. So what they do is they make two entries on their books. One entry is an asset entry, which is the mortgage note that you sign. That's an asset to the bank. And then they create an offsetting deposit to your account, which is a liability on the books of the bank. So by making two entries on their balance sheet, they've created money. That's why I say money is created on the basis of debt. The mortgage note is the basis for creating the money that's deposited to your accounts. Well, this is the inherent flaw in the monetary system, is that banks demand interest on these so-called loans, even though they haven't loaned you anything. The bank didn't give up anything. All they did was to assess your potential of repaying and back that up with real value of your farm. So if you fail to make the payments on your loan, they will confiscate your farm and offer it in the market to someone who has money to repay. So the banks win either way. If you pay back, they're earning interest on the make-believe loan that they made to you, and if you don't repay, they take your farm. Well, the inevitable outcome of this compound interest is sometime the system must collapse. When you have the compounding of interest over time, debt grows exponentially. That's the nature of compound interest. It's an exponential function. So as you go through time, your debt grows. If you weren't making any payments, let's say you borrowed money at 10%, In 1 year's time, if you borrowed $1, you would owe $1.10 at the end of a year. And at the end of 2 years, you would owe $1.21 because you're paying interest on the interest. And so with this compounding process, you end up with this hockey stick curve that Al Gore made famous, where the debt increases and ultimately it explodes. Now, it may take some time, but we've had more than 200 years of existence of our government in the United States, and for most of that period, we've had a government debt. I think Andrew Jackson was the last one to pay off the debt. And then with the Civil War, the debt began to escalate again. Government borrowing basically creates empty dollars, because if the government cannot sell its bonds on the open market to people who have surplus that they want to save, then the central bank will monetize that debt and create new money, even though there isn't any offsetting value of goods and services going to the market. And that's why we've had this recurrent bubble and bust phenomenon. The last cycle was the real estate bubble. We started out with the banks relaxing their normal due diligence in granting mortgages to buyers of real estate. They basically said, come one, come all. If you want to buy a house, or if you want to buy a retirement home or a second home or commercial real estate, we will make it possible for you to do that. We will give you a mortgage to do that. So by making money so easy, you had new buyers in the market bidding up the prices of real estate. So in some markets we had a doubling or tripling of house prices within a matter of 3 or 4 years. Of course, every bubble must come to an end, because once you run out of even unqualified borrowers, and you find that some of those borrowers are unable to maintain their payments, then they begin to default on their loans. Banks begin to foreclose, take the houses, put them on the market for sale, and you end up with a depression in the market. And this is the opportunity that we have now to reinvent the money system. What the possibility is what I call direct credit clearing. Basically, when you think about it, money is just an exchange medium that we use to facilitate the exchange of goods and services. So I come to you and I say, I want to buy some of your consulting services for communications and videography. And so we agree on a price, and normally you would expect me to pay you in dollars or euros or some other currency, depending on where we happen to be. So we become dependent on these national currencies and never stop to think that there might be another way to mediate exchanges. You, of course, want to be able to take your payment and get what you want from somebody else in the economy. Maybe groceries at the grocery store, or a new automobile at the auto dealers. What we can do instead is do a cashless trade. Goods and services buy other goods and services. Money is just an intermediary device. So we can eliminate the use of money. We can simply say, we'll form an association of buyers and sellers, and everybody is both a producer and a consumer. So within this association, instead of using money, we will simply offset our accounts receivable with our accounts payable, or we will keep track of debits and credits. When you sell something, your account will be credited. It goes up. When you buy something, your account will be debited. It goes down. And this is really what banks do anyway. We see very few transactions in actual cash, paper money. Most of the transactions are directly debited or credited to bank accounts. So if you're an employee for a company, your company might deposit your salary once a month to your account. And then you take your debit card or your checkbook and you go shopping. And what happens when you use your debit card is your account is debited. It goes down. So it's simply a matter of numbers in a computer. When you get paid, your number goes up. When you spend, your number goes down. Well, we can do the same thing outside of a bank. We can form an association of buyers and sellers and simply have our own system of accounts. We have the power to decide how we're going to transact business. We simply need to make sure that we have open records and adequate oversight so that the system cannot be gamed. You know, as I put it, I say that this dominant money system has within it a growth imperative. And this is because of the debt imperative. If debt is growing exponentially over time, it means that more and more debt must be created to put more and more money into circulation. Because at any given time, there's never enough money available to pay off the debt that's owed. So unless banks keep creating additional debt on which to base additional money, the system grinds to a halt. We have a depression. So they try to keep up with it by adding more and more debt to the economy. So you have all these players in the economy, individuals, businesses, corporations, trying to earn enough from the market in order to avoid defaulting on their debt. And in the process, of course, what do? We try to produce more stuff. We dig up more minerals. We cut more trees. We harvest more fish. And all of this degrades the environment. And the pressure to pay what you owe to the banks also destroys the social fabric. Everybody's trying to get enough money to avoid going bust. Because of this inherent interest factor that's in bank lending, you have this impossible situation. And so it has to end at some point. Either debts have to be forgiven, written off, or the game will continue by the process of inflation. The Federal Reserve is now monetizing large amounts of government debt, which puts empty dollars into the economy. But what people have to realize is that money has evolved over time. It used to be that commodities were money. And I'm talking about money as a medium of exchange. And so there were many different commodities that were used as exchange media over the years. In the American colonies, it was common to use tobacco or animal hides, bullets, sugar, various commodities that were in general demand that had a use. People would use these as an exchange medium. So even though I might not have any use for tobacco myself, I knew that other people wanted it, so I might accept it in payment for whatever it is that I had to sell, and knowing that